When we understand that, what's the difference? Well, negative gamma coming from call options is because people sell call options, okay? So people sell call options. Negative gamma from puts is because they buy put options. They both result in negative gamma for the marketplace, but they're not as vicious as each other. So whilst the negative gamma that comes from this might be, for argument's sake, $1 billion, and the negative gamma that comes from this might be $1 billion, there's a world of difference between the two elements. There's a world of difference between these two elements as to the market impact that they have, right? So you say, I don't understand. Well, let's assume that this is the price, and the price rallies here. Now, as the price rallies, of course, we get a negative call gamma. Somebody sells a call option. So obviously, when somebody sells a call option here, the market's created negative gamma. The dealer starts to take that other side. Somebody selling a call option. You might be saying, but that's positive gamma. Yeah, but it's negative for the market, right? So when we think about that situation there, we start to understand that that makes life sticky above the top edge. Sticky above the top edge. Now what happens is that this creates gamma positive situation here for the dealers. Now the dealers, the reason why we call it negative gamma is because the dealers don't want to have any positive gamma, so they have to sell that gamma, right? So what happens is the dealer starts selling into this higher price, and it becomes a sticky market. Yeah, becomes a sticky market up here. So obviously, because it's becoming a sticky market, the price kind of slows down. It doesn't necessarily mean the price is going to do that, because there's no sellers at lower prices. This is a seller at higher prices, and a seller at higher prices only a seller at higher prices. So when you think about that, that's one of the big differences between the two types. The call gamma that comes away from that trade. Now, obviously, if we get into the world of buying puts, the gamma is a whole heap of difference, a whole heap of pain potentially. Because what normally happens, of course, is that there is no sellers at higher prices. And therefore, when the price rallies through this phase here, then obviously if somebody comes in and decides to do a put option here, buys a put option here, a cheap put option, as soon as the price starts moving south, assuming that's at the money, what's going to happen is there's a seller at lower prices. And if there's a seller at lower prices in that environment, what happens, of course, is that the market then has the opportunity to aggressively sell away from that area. And that's why we get two completely different situations. This is negative gamma for potentially $1 billion. Negative gamma for potentially $1 billion. And this is negative gamma for potentially $1 billion. Two completely different outcomes because of the type of gamma you're getting. The gamma scalping is not bearish the market, it's just no longer bullish the market. That's the kind of scalping we're getting today. The negative gamma that we get from loads and loads of put options is where the danger's at, right? And there has been an awful lot of call sellers today, an awful lot of call sellers, putting a lot of stickiness at the top edge of the equity markets. So I'm very aware of the equities having a very, very obvious top edge when we come up into that bracket high. There is no way through this price at the moment, this bracket high, the price we've been talking about all morning this morning, coming into this kind of key area here where the price rejected once, twice, three times, coming up for a fourth time. And very, very obvious area to expect to see some delta stickiness, some gamma stickiness, and a bit of a rotation. But unless somebody starts buying some cheap puts, it's not bearish at lower prices. It's not bearish at lower prices. It's only sticky at higher prices. So whilst the gamma might be exactly the same, $1 billion, it is not the same. it shouldn't be measured the same. It shouldn't be even thought about as the same, because it's simply not the same type of impact, market impact. This is gamma scalping from a positive gamma, which is creating a negative gamma. It's actually not necessarily a negative gamma. It shows as a negative gamma, but it's not really a negative gamma. It's a neutral gamma, a zero gamma. Whereas this is a clean, sharp, positive into a negative gamma narrative, and this is bearish. Well, at the moment, the scenario that we have in the equity markets is this scenario here. That's the scenario we have at the moment in equities. And obviously our job is to just be careful about it, because if this scenario here changes into this scenario, then of course with the negative gammas already in place with the people selling a lot of calls, which usually happens first, because obviously people sell calls into that cheaper up price, obviously a lot of calls into that cheaper up price to hedge out their initial exposures without the market collapsing, and then they start taking defensive hedging positions by buying cheap put options. And then we can transition from the very, very obvious top edge here into this type of more negative gamma situation here, which obviously is the market that really can cause serious, serious jeopardy for equities on the way back out, guys. So very, very mindful of that when it comes to a process, to try and understand the process. We are in a gamma negative environment, but it's a call gamma negative environment. So that's obviously something that we just have to be aware of if we're watching the volumes and the open interest in these markets.